So guys, as I say, welcome everybody to the latest Grant Thornton tax webinar. For those that do not know me, my name is Jarlath O'Keefe. I'm a tax partner in Grant Thornton in the Dublin office, and I'm head of the indirect tax department. I really appreciate the fact that so many of you have joined us for today's webinar, the purpose of which is to answer the question, what happens after the 1st of January 2021 when the UK formally leaves the EU, having exited the EU earlier this year. So it'll leave the customs union from the 1st of January. I guess at this stage, we would have hoped to be in a position to discuss the merits of the agreement reached between the EU and the UK. Unfortunately, that is not the case, although the good news is that the talks are ongoing and the mood music is somewhat positive. I understand that Michel Barnier, the lead negotiator for the EU, is in London today. So fingers crossed that they make some progress with that. I hope after listening to my colleagues, you will be somewhat clearer in respect to what is going to happen, and most importantly, in respect to the practical steps that businesses should take to mitigate the disruption of the new regime. There will be a Q&A session at the end, and there's a facility for you to ask questions, so please do so, and we will try to answer as many as we can in the allotted time. And any questions that we don't get to, I will ensure that we get back to you individually after those. The format of the webinar will be as follows. Lindsay Bell will provide an overview of the economic climate, particularly with Brexit and COVID in mind. Lorraine Nelson will review the corporate and international tax issues. Jeanette Maxwell will run through the Irish indirect tax issues and will provide some practical tips. Lee Squires will do likewise for the UK VAT position, and with a focus on the Northern Ireland Protocol. Finally, we will have the Q&A session. I think there are only 74 days left until January 1st, so Brexit is very much a focus for those businesses who trade with the UK, with NI, and between UK and the rest of the world. At the minute, there seems to be three possible outcomes. No-deal Brexit resulting in the implementation of WTO terms. The EU and the UK agree a deal which will come into force on the 1st of January 2021. And this should ensure that there'll be no tariffs between trade between Ireland and the UK, although there will be administration issues and customs clearance required. And thirdly, and perhaps given the tight time frame that is left, the parties might agree to close, or that they are so close to an agreement that they will allow trade to continue as is, with a view to implementing the agreement in the coming months. Let's hope it's either 2 or 3. In any event, enough of me, and I'll pass you on to my colleague Lindsay Bell to go through the economic outlook.
Thank you, Jarlath. Good morning, everyone. My name is Lindsay Bell, and I'm an Associate Director with the Economic Advisory Unit of the Business Consulting area in Grant Thornton. I'm going to give you a very quick overview of the current economic situation to try and set the scene for today's seminar. We'll touch upon the global context that we face, and for all of us that were already sick and tired of hearing about the impacts of Brexit in recent years, we now have COVID-19 to contend with on a daily basis as well. We'll discuss the key issues as they pertain to our future prospects and where we ultimately go next. We can move to the next slide. We live in uncertain times. How many times have we said and heard that over recent years? We all know that uncertainty makes it difficult for organizations and companies to plan for their future. What is the right course of action to take? It's very difficult to know, and uncertainty certainly doesn't help that. This particular slide is based on the work of the International Monetary Fund, and it measures uncertainty in a global government policy context. It does so by text counting for the word uncertainty or synonyms of that word, and shows just how often that appears in global policy. Typically, I would update and present this slide around budget time each year in order to drive home that point that we live in uncertain times. But if you look at the last decade, you will see some of the most uncertain times in the history of the index, which dates all the way back to the 1950s. So between Brexit, US presidential elections, US-China trade tensions, and more Brexit, we've been on quite the roller coaster of uncertainty over recent years. And then, as you can see from the chart, 2020 comes along and effectively says, hold my beer. Coronavirus has overtaken so much of what we do in our daily lives. It's arguably the largest truly global event since World War II, and even possibly as far back as the Spanish flu. And it doesn't look like it's going away anytime soon. If we move on to slide 2. It's had an unprecedented impact on global GDP as countries around the world have entered into some form of lockdown in order to take measures to reduce the impacts of the virus on our civilization. Ireland's economy shrank by 6.1% in Q2, as we can see from this chart, while the US and UK economies suffered even greater falls of 12% and 20% respectively over the same period. Across the whole of the EU, the fall was 12% in a single quarter. By comparison, the global financial crisis, the contraction in GDP in Ireland, for example, in a single quarter was just 4.7%. So we're overtaking even that as it stands. If we move on to slide 3. Despite that, the labour market and indeed much of some parts of the economy has remained much steadier than you would perhaps have anticipated given those unprecedented drops in GDP. Though as we know, it's perhaps very much artificially so, as governments around the world have sought to provide some form of support, whether in the form of pandemic unemployment payments or wage subsidy increases schemes, in order to try and help keep people in work in the hope that the pandemic can be ridden out without significant lasting damage to the economy. If we move on to slide 4. As a result, impacts have varied hugely across different sectors. So roles such as office professionals, such as ourselves as consultants, perhaps have been largely unimpacted, other than the fact that every single Zoom, Skype, WebEx, Teams meeting has been interrupted either by a small child running into the room or shouts of, "Are you on mute?" I'm sure we've all heard that many times over the last few months. Whereas if we were in the hospitality and tourism sectors, we would have suffered far more significantly, even at this point, with potential future further pain to come. If we move on to slide 5, the consequences of this, the consequences are wide, they're vast, but they're as yet unknown. As is often the case with many of these things, there appears to be a wait and see approach that's being taken across many economies and individual organizations, and indeed in households. What has been shown, though, and which is particularly relevant for Brexit as well, is it's shown our ability to adapt to a new way of life at short notice, despite the huge number of disruptions that we've seen across households, governments, businesses. It's very likely that we're going to see an unprecedented paradigm shift in terms of how people work, how we socialize, how we interact with others, and how businesses operate, whether that's having to source new supply chains, how they deal with their customers, or even if you're in the retail sector, how you engage with your customers. If we move on to the next slide. Anyone standing here or sitting here as I am would not honestly be able to tell you where this is going and how things will turn out with any degree of certainty. What we do know is that governments, national and supranational, are putting together significant stimulus packages. The EU is putting together a 750 billion package in grants and loans over the next few years to support a whole range of sectors. What we don't know, however, is how and when this will need to be paid back, or how quickly a recovery can take place. If we move on to the next slide. What we did see, however, which perhaps presents some positivity for the future, is that we did see an immediate start of a bounce back in the summer months as countries moved out of lockdown. That happened up until August, whenever numbers started to rise again in terms of virus numbers. And certainly in September, we realized it was very much a second wave. In October, governments started to lock down again. That's had a significant impact in terms of confidence, both consumer and public confidence, and again has created a real uncertainty for where we go in the future. If we move on to the next slide. The positive news is that despite that, the EU is still predicting significant growth across the sector in the next year of around 6%. The contraction this year is expected to be between 8 and 9%. So we won't quite be where we were going into this year, but it does present a rosier picture for the future. If we move on to the final slide. Ultimately, though, we're back at where we began, which is that uncertainty. Uncertainty in this case as to what that recovery will look like. We know it will happen, but when it will happen, to what extent, or what shape that recovery will take. As we can see in this chart, we're referring to it almost as an alphabetic spaghetti, the recovery alphabet. I've seen predictions of a V-shaped, U-shaped, Nike swoosh, Z, W, L-shaped recovery. Any or all of these could be true, or none of them could be true. We just don't know at this point. What history does tell us, though, is that the companies, organizations, and countries that develop robust plans, put them in place and enact them and take action early, are likely to be those that will fare best and come out of this, both the coronavirus and also the Brexit situation, in the best possible shape going into the future. Thank you.
Good morning, everyone. My name is Lorraine Nelson, and I specialise in international tax. And over the last 3 to 4 years now, we've been looking at Brexit with quite a number of our clients. And unusually, I'm just ahead of the indirect tax guys, who have all the nice detail around the VAT and customs issues that will be arising. I just wanted to quickly highlight some issues that maybe aren't as widely publicised. Obviously, there in January of this year, the UK, was no longer, it did leave the EU as a member state in legal terms. However, there's lots of directives that are, not including the UK as part of that. However, as part of the transition period, a lot of those directives are still applying now until the 31st of December. So at the end of the transition, as Jareth had said, there's still negotiations ongoing. However, we haven't really seen anything in relation to the directives. So that's looking at the likes of your parent subsidiary directives and in respect of any payments of dividends, interest or royalties, or any sort of cross-border mergers. So if you are moving assets from one member state to the other, any of those sort of tax charges or exit charges can usually be mitigated. However, if you're moving things then from the UK to the EU or vice versa, those are likely not going to apply from the 1st of January onwards. So it's probably then having a look to see what are your payments and how are you repatriating profits back either into Ireland or the UK, or making payments between the two jurisdictions, and you just need to look to see whether you're going to be impacted by any of the withholding taxes. So usually the parent subsidiary directive as part of the EU, there will be no requirement to withhold that tax. So you just need to then have to look to the treaty network. Now there is some concessions already. So for example, in dividends, in the UK, there's no tax on dividends received by corporates in the UK. However, some jurisdictions will apply a withholding tax on any payments that are being made to the UK for dividends. Now, fortunately, Ireland has made domestic legislation to allow that wouldn't apply. So any dividends paid from an Irish company to a UK company will have no requirement for withholding tax. So it means you're not going to have any sunk costs there. So it's just really if you've got payments or any subsidiaries in any of the other jurisdictions within the EU, it's useful to then look to see what the double tax treaty says. Now, majority of those will allow that to be a 0% withholding tax, but you just need to see how do you how can that apply? There might be some additional paperwork that may need to be applied for that. So it's worthwhile having a look at that. And that's probably one of the main points. Then just next, I just wanted to run through a few things that you may also want to consider. Just having a look to see if there's been anything that you've implemented in your group structure. Has there been anything transferred that have used any of the EU directives over the last number of years to see if there's any clawbacks, or if you have moved things and you're making use of any payment plans that are allowed under the EU directives, just to see if those are being cut off and you're going to have to maybe make any of those payments upfront instead of over a number of years. And suppose just a lot of focus has been looked at around the supply chain and how you're going to get your goods moving and how services will be provided between different jurisdictions. And Jeanette and Lee will come into sort of how that will impact you from an indirect taxes point of view. But it's also worth noting to see if you are moving things between different companies within your group, and that work and additional added value is happening in different jurisdictions. You know, there's a real significant transfer pricing impact on that, as to where your profits then should be allocated, and whether you need to reimburse another company within your group for undertaking that additional work that they're now doing. It's also then to have a think about any funding and around the interest restrictions that are applying as part of the EU and also in the UK as well. And also, if you are thinking of providing funding or receiving funding from different jurisdictions, is also just to consider that withholding tax point as well, which could potentially be a cash flow issue as well for the group. One thing that has come through as an EU directive over the recent years has been the DAC 6 reporting. So that's an obligation across all EU countries, where if you're transferring or there's any arrangements in place that are impacting two jurisdictions, that there may need to be a reportable event to your local tax authorities. Now that applies in Ireland and also applies in the UK at the moment, and that will apply also in the UK going forward. So it's worthwhile just making sure that you're compliant with that as well. And just finally, just making sure that whenever you're sending people into different jurisdictions, that they're have consideration for their social security contributions, because there's some reliefs that are available as part of the EU, so that you're not paying social security in two jurisdictions and being able to claim the tax credit relief for that. And I'll just pass across to Jeanette then on the indirect tax side of things.
Good morning, everyone. So the purpose then of my presentation is to take you through some practical guidelines, which will hopefully save your business time and cost from an indirect tax perspective here in Ireland. Next slide, please. So from 1st of January then of the new year, we're no longer regarded as intra-community supplies when we're trading with the UK. So this does create significant changes in the landscape. We're now dealing with imports and exports. So the first piece of practical advice that I have for you is to obtain an EORI number if you have not already done so. So this is absolutely crucial, because from 1st of January 2021, you will not be able to trade with the UK if you do not have this number. So you can apply for the number on Revenue's online service on Ross, and you will need a customs and excise registration in order to do so. So once you've got your EORI number, you will automatically be assigned a trader account or a TAN, and that's the forum then by which payments can be made. There is a possibility then to apply for a deferred payment authorization, and this will allow your business to import product in 1 month and defer the payment until the 15th day of the following month. So a positive there from a cash flow perspective. You will need authorization and also a comprehensive guarantee, and that's to ensure any customs debts that will arise in the future. And the application for that then is made on the European Union website, europa.eu. Next slide, please. It is without doubt then that there will be a lot more delays and a lot more on the administration side from next year. So it may be worthwhile for your business to apply for AEO status, which stands for Authorised Economic Operator. So this status seeks to reward the good operators, and it encourages international best practice in supply chains. So the benefits would be reduced frequency of customs checks and potential fast tracking of consignments, and potential international recognition then of AEO status in all countries where mutual recognition agreements have been signed. The benefits then from a customs perspective, guaranteed waivers or reductions, and also what all your businesses will want, much faster access then to some custom simplified procedures. Next slide. So how is this obtained then? Well, your business will need to have very high standards under a number of headings. These include safety and security, systems to manage commercial records, compliance with customs rules, financial solvency, and practical standards of competence or professional qualifications. Now, a business can apply either for AEO status in relation to customs simplification or in relation to security and safety, or depending on the type of business then, both of the above. So the same criteria will apply regardless of the size of the business and whether it's an importer or an exporter, etc. So next slide, please. So there will be much more on the administration side in terms of customs formalities, as declarations will need to be submitted. So it's really important, you know, with just over 2 months given this consideration, it's important to determine whether you will do the customs declarations in-house or whether you will outsource these to a customs agent. And whether it's yourself or a customs agent, there should be a really clear document retention policy in place, because record keeping will be absolutely crucial. In the event of scrutiny or future audit, it's really important that you can establish how the customs liability arose. So as you'll see on the slide, the type of supplementary information that you should hold on to will include commercial invoices, bill of lading or airway bill, packing list, veterinary or plant health certs, or licenses. But of course, it will be very much dependent on the type of business. Next slide, please. In terms of the actual information that's required on the declarations form, so the key data then will extend to customs codes, because those determine the duty that's payable. The customs value of the goods, so that's very important. It's the value plus any insurance or transportation costs. The origin of the goods then, this is important because sometimes the origin of the goods is confused with the country of import. So the country of origin then is where the goods are wholly obtained or produced, and it can also include the place where the goods have undergone a substantial transformation or change. Again, in terms of your customs compliance, who's going to do that? But remember, if you do outsource the preparation and the filing of these declarations, you're not outsourcing any responsibility. That still rests with you as the trader. Next slide, please. Just some other key points to be aware of. The very nature of import VAT means that the VAT must be paid upfront before the goods are released for circulation into the EU. Of course, that can have a negative cash flow impact on the trader, because they would then have to wait until the VAT return is filed before they would get their VAT refund. The Brexit legislation that we have at the moment does provide for VAT postponed accounting, and that would be very beneficial, because the VAT could then be paid over when the VAT return has been filed, and at the same time then the VAT input credit could be offset against that. So that would be a really positive result and a really good result on cash flow for traders. Some other points to note then: any business to consumer supply of services, so depending on the type of service, no longer subject to VAT. So typically that would apply to advertising services, services of consultants, engineers, accountants, so professional services. And the final point on this slide then, there will be increased VAT recovery for Irish entities supplying insurance and financial services to UK customers. And this is because the UK is no longer part of the EU, and the VAT legislation as it stands does give VAT recovery where supplies are made of those services outside the EU. So that's a welcome development, because as you know, insurance and financial services would have very low VAT recovery. Next slide, please. So in terms of the practical advice then, so what should you do right now? Absolutely obtain an EORI number. That would be crucial if you still intend to trade with the UK post-Brexit. In terms of your supply chain, it's important that that is reviewed frequently, but if you haven't had a chance to look at that in a while, that's something we would recommend doing over the next couple of weeks to see if there's any changes to the supply chain that can be made and any costs that can be mitigated. Be familiar with commodity codes applying and the tariff rate. Consider who will file the declarations. It's also important to review supplier and customer agreements and consider the implications of any Incoterms post-Brexit. So, for example, if you happen to be a UK business and you have agreed to supply goods into Ireland on DDP terms, that means delivery duty paid. That means that you're responsible for getting the goods into Ireland and also paying any perhaps duties that apply. So if you haven't reviewed your agreements in a while, again, really crucial that that is done, just to make sure that both parties understand what their obligations are, and of course, changes may need to be made to those. If you do feel that you need to get an Irish VAT registration, we would say apply now. Don't wait until the end of December or wait to January. We've really good relationship with the Irish Revenue, and they have said to get your applications in early, and then they can make the application live then on the 1st of January if needs be. So the final point then, just from the finance bill that was published yesterday, it made provision that Revenue may request that a non-established trader here in Ireland may need to appoint a tax representative in Ireland that would be jointly and severally liable for any VAT liabilities. So this would apply where Ireland does not have a mutual agreement with the jurisdiction where the trader is established. So I just thought I would mention that today, as that may be relevant for UK businesses then that have Irish VAT registrations. Okay, so I'll just pass you over now to my colleague Lee Squires to take you through more of the detail on the UK side. Thank you.
Hello and good morning, everyone. So my name is Lee Squires. I'm a tax director in our Belfast office, and I lead our practice in Northern Ireland on VAT and customs. So next slide, please. So I'm going to talk to you today about the UK VAT and customs issues that will arise from the 1st of January next year. Just as a recap, I think it's worth just talking through the three different possible outcomes of Brexit that Jarlath mentioned at the beginning. So firstly, we could have a deal between the UK and the EU, and they could reach a free trade agreement. But it's worth pointing out that this is not a continuation of the status quo, that customs checks and regulatory checks will still apply in the event of a deal. So most of what we're talking about today will still apply even if there is a deal. And this also means, of course, that the UK will leave the single market and customs union and the EU VAT area. And there will be other implications as well, including an end to free movement of people and less access for regulated services. If we don't get a deal and we have a no-deal Brexit, then the UK and the EU will trade on so-called World Trade Organization terms. And the real difference there for these purposes is that there will be then substantial tariffs on the movements of goods between the EU and the UK. And finally, we could end up with a sort of fudge where the UK and EU maybe find a way to maintain the status quo, possibly with some kind of implementation period or a temporary continuation of zero tariffs while some parts of the deal come in and other parts are still being negotiated. Next slide, please. But in any case, Northern Ireland is in a very special position because of the Northern Ireland Protocol to the withdrawal agreement, which will come into the force on the 1st of January, regardless of whether there's a free trade agreement between the EU and the UK, although the existence of a free trade agreement could have some impact on how the protocol is implemented. So under the protocol, Northern Ireland will effectively remain in the EU single market for goods on both agricultural and industrial goods, so that there's a harmonisation therefore on goods standards with the Republic of Ireland, and therefore no regulatory checks on goods moving between Northern Ireland and the Republic of Ireland. So that ensures there's that free open border between north and south of Ireland. But the quid pro quo for that is that there will then be some regulatory checks on goods moving from GB to Northern Ireland, and that would include the sanitary and phytosanitary controls on agri-food products in particular. So from a customs perspective, technically Northern Ireland is said to be part of the UK customs territory, but in practical terms it follows EU's customs rules and imposes EU's customs duties. It also follows EU VAT rules in relation to goods, but confusingly not in relation to services. And we'll come on to look at what that means. Now, this doesn't necessarily last indefinitely because it's subject to the democratic consent of the Northern Ireland Assembly after 4 years from the end of the transition period, so by the end of 2024. And if there is a vote to discontinue those arrangements, then they end 2 years later at the end of 2026. So end 2026 is the earliest that the arrangements could end. And if they voted to continue, then there will be periodic votes thereafter. Next slide, please. So for today's purposes, I'm going to consider the VAT and customs issues arising under 4 scenarios for goods trade. The first one will be trade between Great Britain and the EU, which includes the Republic of Ireland. And then we'll go on to look at the trade flows between Northern Ireland, EU, Great Britain and the rest of the world, because Northern Ireland is in this special position under the Northern Irish Protocol. Next slide, please. So looking first at the GB to EU trade, and so Great Britain here includes all of the United Kingdom apart from Northern Ireland. So from a VAT perspective, in the same way as Ireland, the UK will introduce postponed import VAT accounting. So rather than having to pay the import VAT when the goods cross the border, it's effectively accounted for in the importer's VAT return. So that is a cash flow saving for traders, even if they can recover the VAT. It's worth noting that depending on how you wish to deliver your goods to your customer and who wants to take responsibility for import formalities, you may need a UK VAT registration. So for many Irish suppliers are finding that their UK customers are saying, well, we still want to continue to receive a duty-paid good delivered to our premises. So that means that the Irish company will effectively need to register for VAT in the UK, act as importer of record and fulfill those import formalities, and then use their UK VAT registration to recover the import VAT before making a local sale in the UK. So that's worth bearing in mind, as well as the customs registrations. There are also some special rules for low value consignments of goods coming into Great Britain with a value of £135 or less, which will affect sort of e-commerce sales from, say, Ireland into GB. And there's a special regime, but broadly, if the value is equal to or lower than £135, then the supplier must charge VAT at the point of sale rather than VAT being accounted for on importation. Next slide, please. So looking at the position for exports from GB, so at the moment, if you're selling from GB to an EU member state, that's an intra-EU dispatch. It now becomes an export. It's still zero rated, but the evidence you need to retain is slightly different. EC sales lists will disappear for GB businesses. It's also worth noting that the UK will no longer have access to the EU's VAT simplifications that apply things particularly around the triangulation, which is where there's a supply chain from A to B to C, but the goods move directly from A to C. And in those circumstances, it may therefore be that a local VAT registration is required, for example, in Ireland by the UK supplier, in the same way as an Irish supplier might need one when supplying the UK. And that will also be the case if the UK supplier wants to supply the Irish customer on DDP terms. Next slide, please. In terms of services, I mean, broadly, the place of supply rules will remain the same, but there will be some exceptions, including, as Jeanette mentioned, business to consumer supplies of certain services to persons in the EU, which will no longer be subject to VAT. The UK will close its mini one-stop shop system for digital services. So that allows you, that's a system that if you're making supplies of digital services to consumers in EU member states, you can register in one country and account for VAT on your supplies to consumers in all EU countries through one portal. So if you're using the UK MOS system, you need to register in another EU country, perhaps Ireland, for example, and you will need a separate then UK VAT registration for supplies to UK consumers. Next slide, please. From a customs perspective, as in Ireland, there's a requirement to make import and export declarations when goods are exported or imported. So there's a decision really to be made as to how you will comply with those formalities if you're going to be the importer of record. So will you use, many businesses will use a customs agent or freight forwarder to make those declarations, as they currently do for their international trade. But some businesses are looking to do this in-house post-Brexit. So that involves getting third-party specialist software to access HMRC systems and then authorization and training your staff. And it's worth bearing in mind that there's supplementary information needed as well to complete the customs declarations. And as Jeanette mentioned, those are things like commercial invoices and packing lists. You should obtain an economic operator and registration and ID number, an EORI number if you don't already have one, and that can be applied for online. And the UK's tariffs will change post-Brexit. The UK has announced a new UK global tariff schedule. This is based on the EU tariff, but includes a number of eliminations and simplifications. So some duties have been eliminated or simplified. So in principle, that will apply to trade between the EU and GB from 1st of January, but it's subject to the terms of any UK or EU free trade agreement. So the hope is that an agreement will be reached, which means that tariffs do not apply to goods of UK or EU origin traded between the countries. And next slide, please. It's worth just mentioning, though, that the UK has agreed to introduce its customs controls on a phased basis initially. So for the first 6 months, from the 1st of January to the 30th of June, for standard goods, which are most goods, you only have to record the entry in your commercial records. You then have until the 1st of July to submit a supplementary declaration and pay any duties due. And no entry summary declaration is required in that period, and that's the so-called safety and security declaration that the operator of the means of transport normally has to complete. But it's worth noting there that the controlled goods will require declarations, and that includes excise goods like alcohol and tobacco. So there's a little bit of leeway there in terms of being prepared to comply with those customs formalities. And then, but from the 1st of July, the full import controls will apply. And it's worth saying that this only applies to the UK. So this doesn't affect imports into the EU from the UK, where full controls will apply from 1st of January. Next slide, please. So in terms of thinking about your customs compliance and submitting declarations, I think you need to think about some of these topics. We often talk about the 4 pillars of customs compliance. So that's classification, having the right commodity code for your product. The customs value, which includes insurance and freight charges in some cases, not only the value of the goods, and their origin, which is not the same as where they move from and can be complex depending on the origin rule that you're applying, and whether that's under a free trade agreement. It could be, for example, where the goods are substantially transformed. And then in terms of procedure, there are some special procedures, next slide please, that we can look at that can help to mitigate duties. And those are mentioned there. So for example, inward processing is helpful if you're importing goods with the intention of re-exporting them, and you know it is possible to mitigate or suspend duties there. Outward processing, where you're sending goods outside to be processed and then re-importing them, and customs warehouse, which allows you to keep goods in duty suspension. I should also say that the authorised economic operator status that Jeanette mentioned is also available in the UK. And finally, the UK is trying to roll over the EU's existing free trade agreements with third countries to the UK. And it has secured continuity free trade agreements with many of those current countries, but not all of them. So if you rely on an EU free trade agreement, it's worth considering whether that will still be available after Brexit. Next slide, please. That's gone through the GB to EU issues. I'm now just going to turn to look at the issues under the Northern Ireland Protocol, which will be relevant to businesses in or trading with Northern Ireland. So under the protocol, most EU VAT rules on goods will continue to apply in Northern Ireland, and also excise duty rules, although we're not going to talk about those today. So this means the UK potentially has 3 VAT regimes after Brexit: the Northern Irish rules for goods, which have to reflect EU law, Great British rules for goods, and then UK-wide rules for services. And exactly how all of those will interact is not yet clear. It's worth saying that some operational aspects still have to be agreed in terms of the operation of the protocol, and there is a difference of opinion between the EU and the UK as to how it should operate. Next slide, please. So looking first at the position between Northern Ireland and the EU, which includes the Republic of Ireland, in many ways is the easiest part of the system, because the current VAT rules continue to apply in Northern Ireland, and so that means that B2B supplies will continue to be treated as intra-EU dispatches, so 0 rated by the supplier, and then with the customer then accounting for the VAT, and B2C supplies will continue to use the current distance selling rules. And in order to facilitate this, the European Commission has said that it will introduce a special VAT ID number for Northern Irish businesses, and they can continue to use the EU VAT refund system for VAT incurred on goods. Northern Ireland will also need to apply the changes to the EU rules coming in from July 2021, although we won't look at those in detail today. Next slide, please. From a customs perspective, because the EU custom rules continue to apply in Northern Ireland, there'll be no tariffs, customs controls, or declarations required, and so the frictionless border with the Republic of Ireland will be maintained. However, there's a bit of complexity when you move goods through Northern Ireland onto the EU using the UK land bridge, and there you will have to use a customs transit procedure to keep the goods in duty suspension so that there's not a re-import of the goods into the EU. So there will be some extra procedure and complexity there. Next slide, please. Northern Ireland to Great Britain is in many ways now the most complex regime. So from a VAT perspective, the position is not yet wholly clear. According to the European Commission, the movement of goods should be treated as imports and exports, not as a domestic sale of goods. So that probably means that the importer has to account for the VAT, but postponed import VAT accounting should be available. Customs, if you're moving from Northern Ireland to GB, the UK has said that Northern Irish goods should have unfettered access with no import declarations, tariffs, or customs checks. But this only applies to Northern Ireland qualifying goods. So there's a question whether your goods will be have this qualifying status. There's some draft legislation at the moment, which I think is going to be amended, but it looks as if goods will only have to have had minimal processing in Northern Ireland to qualify for to qualify as Northern Irish goods. And this also begs the question as to how tariffs will be imposed on non-qualifying goods if there are no customs checks or controls. So export declarations are not expected to be required. There is an issue for goods moving to GB via ROI. So if you're going down to Dublin and then across to a GB port, and there it gets a little bit more complex. There would then need to be export formalities complied with in the Republic of Ireland. And there's also a question whether goods moving in that way will benefit from unfettered access and whether they will have to move in a customs transit procedure as well. Next slide, please. So GB to NI, when goods move from GB to NI, there will be import declarations required when they enter Northern Ireland, as well as safety and security declarations by the transport operator, although the UK has said there will be no physical customs infrastructure. So there is a trader support service that the UK government has launched in order to assist businesses with completing these declarations. That's a free-to-use service that is recently launched, and that will give support for submitting these customs declarations and also some online trading. I think it's fairly fair to say that the trader support service is more limited than had originally been understood. It won't give you sort of bespoke advice or value-added assistance. So there's still, so I think the TSS is one part of the solution, but there are many other issues to consider. And businesses should, you know, in the same way as for GB to EU trade, think about whether they want to use the TSS, use an existing customs agent, or even do the work in-house. The TSS is not compulsory, but will may help, particularly with smaller traders. Next slide, please. So tariffs could potentially apply when goods move from GB to NI. So the EU tariff applies if the goods are at risk of moving into the EU, whether by themselves or forming part of other goods following processing. And unfortunately, the criteria for when they're at risk hasn't yet been agreed. It's to be determined between a UK and EU joint committee. So we don't entirely know what those criteria are, but it's clear that the EU is concerned with goods moving into Northern Ireland, being processed in Northern Ireland, and then moving on to the Republic of Ireland. So it's not this doesn't only apply when goods are simply transported through Northern Ireland. It will affect manufacturers in Northern Ireland that are using GB raw materials. However, subject to EU state aid rules, the UK may reimburse these duties in certain cases, although again, we don't have any clarity on exactly how that will work. It's also worth saying that the position depends on whether the UK and EU agree a zero tariff FTA, when there will be less of a need for these tariffs. But it's still, the customs controls will still need to apply because there could be third country goods moving between the UK, GB and NI. Next slide, please. And so the final trade flow I'll consider briefly is Northern Ireland to the rest of the world. And I think the key point there is that the UK, on import into Northern Ireland, the UK tariff will apply unless the goods are at risk of moving into the EU, in which case the EU tariffs will apply. But Northern Irish goods may benefit from UK free trade agreements with third countries. Next slide, please. So I'm not going to go through this in detail, but this is just a table that illustrates some of the permutations possible under the Northern Ireland Protocol, with goods moving from one territory via another and ending up in another territory. And it doesn't cover every combination and doesn't look at processing in the intermediate territory or reliefs, but it gives you some feel, I think, for the potential complexity of the protocol. Next slide, please. And so finally, I'm just going to talk through a few points that businesses can do to prepare. So firstly, you should consider how you will submit your customs declarations, as I've discussed, apply for an EORI number, look at your commodity codes and the relevant tariffs under both the EU tariff and the UK's new tariff, and think about which party is responsible in your supply chain for import formalities and duties. Often existing contracts will be unclear because they're not designed to deal with post-Brexit trade. So you need to think about who's going to be the importer of record, as that could mean you having a VAT registration and having to be needing a customs agent in your customer's jurisdiction. Look at some of those customs special procedures and reliefs. Could they help you here? And look particularly also at the VAT changes. Don't overlook that in terms of when you're looking at these. It's not just customs, and new registrations may be required. Next slide, please. And then finally, for businesses in Northern Ireland, there are a few extra things to consider. So look at those transit procedures when you're moving goods through the GB land bridge to the EU, or moving through Southern Ireland between Northern Ireland and GB. Think about the risk requirement and the qualifying status requirement and the VAT changes, and also the origin of the goods for the purposes of the UK and EU's free trade agreements. So I think it's tolerably clear that Northern Irish origin goods will benefit from UK free trade agreements, but the position under EU free trade agreements is less clear. And there are issues, for example, if Northern Irish products move down to Ireland and then are somehow processed or incorporated into Irish goods, whether that could disqualify those goods from being of EU origin for the purposes of the EU's free trade agreements. So that's all I was going to say, and then we're now going to move on to the Q&A session.
Yeah, thanks Lee for that, and thanks all the panelists. It is very informative. There's a lot of information there. there's been a few questions in relation to, well, there's been a number of questions, and firstly, we'll try and get through as many of the questions as we can. Firstly, I do think we will be able to send all the slides out to everybody. It's bank holiday here in the south on Monday, so look, if you haven't received them by Tuesday or Wednesday, if you just look up my email address on our website, and I'll make sure that you get them. There's been a common theme as well in relation to a question around EORI numbers, and if you need to obtain an EORI if you're supplying services from Ireland to the UK. And I'll answer that one because it's an easy one. The answer is no. So that's grand. That's me out of the way. There is, and this is a good planning idea, I would have thought, but I don't think it works. Lee, in terms of moving goods from the south to the north and going on to GB, I assume customs clearance will still have to apply. You can't avoid customs clearance in by doing that.
Yes, I mean, this comes down to the issue of whether the goods have the qualifying status in Northern Ireland. So there's only unfettered access if your goods have qualifying, Northern Irish qualifying status. So the expectation is that if you simply move goods from the Republic of Ireland into Northern Ireland and then on to GB, that they won't have that qualifying status. And so so customs controls will still apply. So there isn't a sort of easy backdoor into the UK market through Northern Ireland, unless there's some processing being done in Northern Ireland. Yeah,
I would suspect not. There's another one for you, Lee, when you're on, just in terms, and I think you answered this during your presentation. I think there's a little bit of a disappointment in regard to the Trader Support Service being used by HMRC. Do you know, is there an expectation that will be developed and there will be, say, tariffs on that? And will it give specific, what does products moving from NI to GB, will there be, for instance, I think it was specific to tea and coffee. Will that be allowed to continue?
I think the Trader Support Service is more limited than we had hoped. My understanding, there will be sort of generic training, and there's some of that available already. And then there will be the platform for submitting digital declarations, and then a call centre to support people who are having trouble with that platform. But it also wants to know your suppliers so it can contact them, because they will have to provide some of the information. But I don't think it's going to do some of these other things that are mentioned in terms of providing details of commodity codes or charges or restrictions. That my understanding is that won't be available. That will be more a question of looking at the wider government advice or taking advice on those requirements.
Okay, Jeanette, I think you brought up the issue of increased recovery for entities that are supplying financial services to the UK, and the fact that it's not now non-EU, the recovery rates should increase. And there's a technical question, I guess, here. Will that recovery rate increase from the 1st of January 21, or could it apply from the 1st of January 20? And I'll throw in my tuppence worth. I think the revenue will certainly answer that it should apply from the 1st of January 21, but I suspect, due to the fact that the UK did leave the EU from the 1st of January 20, I think there's a good argument to suggest that should apply for this year's trade as well. I don't know if you have any thoughts on that.
Yeah, absolutely. And it's something that I suppose we would expect, clients to be picking up on that point. That, there is an argument given that they did, I suppose, leave earlier on in the year. So I would agree that there would be an argument. Whether or not revenue will agree with our argument is another matter. But there's certainly scope then to have it applied in 2020 as well.
I think the view taken in the UK is that it applies from 2021, because the withdrawal agreement sort of deems the UK to be an EU member state for most purposes during that period. So that's why we still have sort of intra-EU acquisitions and so on with the UK. I mean, whether it's possible to make a special argument for that particular relief, I'm not sure. It might depend on the Irish legislation, but that's sort of the EU line, the UK line, I suppose.
Yeah, maybe we're just a little bit more aggressive on our tax planning there, perhaps. I think, Lee, this is one for you as well in terms of ESS or non-ESS sales, and I think you covered this in your presentation as well. The EU is introducing legislation from the 1st of July 21. My understanding is the UK is introducing that legislation from January next year. This is for, I think you referred to the consignment stock and non-electronically supplied services.
Yes, so the UK isn't making the same change as the EU, but I guess the UK is in a bit of a different position now because it stands as a territory on its own, and it will have these special rules for low value consignments, for example. But it won't be part of that new UK one-stop shop, the new EU one-stop shop system. But
effectively, will it have its own, or?
So I think if the package is worth £135 or less, then the VAT has to be accounted for at the point of sale, and rather than on import. And there's also involvement of where a sort of an online platform, an online marketplace, takes part in the sale, to be the supplier as well, and has to account for the VAT. So that's another change related to that. But yeah, I mean, I guess the point of the one-stop shop is that you know that means you've got 1 point for accounting for all member states, but we're part of the EU and we're one country. So
yeah. Jeanette, another one, I guess for you. Someone's asking the question in relation to goods moving from being supplied by an established entity in the UK into Ireland, but delivered from, say, Germany, and they're asking the question, can they still avail of triangulation?
Yeah, well, I think as the UK is no longer part of the EU, then the triangulation won't apply because you'll need your three member states. So the UK no longer be a member state. So we'll have to look at, there may be alternatives to your supply chain that can be made, but certainly triangulation won't be available.
Yeah, and I think there was a question from Jane and it was around I think goods moving from the UK into Ireland and accounting for VAT, and it was around could logistic companies or could the retailer supplying goods into Ireland account or collect VAT up front? But Jane, I'll get your details and we'll send you an answer. That shouldn't really be an issue because we'll introduce postponed accounting from the 1st of January 21. That's already in Brexit legislation that we will introduce. This is, I guess, for anybody. What is the definition of a trader? Is it just about making and or supplying goods? I guess it is. I think that the questioner has answered the question. I think it is anybody that is carrying out economic activities and effectively trading and supplying goods or services. There's one for you, Lee. Do you know if there's a question from one of the participants has construction sites in the UK and use EU subcontractors? Do you know how that's going to work? I think it's a more complicated issue. But...
Yes. Well, I suppose it depends what the subcontractors are providing. So if they're providing, are they just providing a service, or are they bringing goods into the UK? So if they're bringing their goods into the UK, then they potentially need to consider some of these, the customs issues and VAT issues that we've discussed. But it would very much depend on what the subcontractors are doing and whether they're do they have employees in the UK? Where are the goods located? Yeah.
I'm running out of time here, but look, we'll come back. I think that was a Mr. or Mrs. McManus. We'll come back on that one, and as I say, we'll try and get back on all of these questions and supply answers to them in the next few days. And there's one in here from a school and a charity only registered for VAT under the principal contractor rules. Jeanette, as the value of goods imported falls under 35k, we do use a number of UK software service and purchase some UK goods. What record keeping applies for goods we import, and do we need to employ an agent to manage these imports? I think that the question in essence is if there's a limited amount of imports coming in, what do they need to do?
Yeah, I suppose it depends on, you know, the record or the record keeping and the declarations. If you're maybe, you know, happy enough to do them yourself, if it's a low number, then, you know, you might be. But I suppose keep as much documentation as you can. You'll need to have proof as to where the goods came from and how they, you know, came into the country, and all of the detail that was covered off in the slides. And I suppose in terms of the length, the customs formalities say you should hold on to your records for about 4 years, and the VAT is 6. So we'd probably recommend keeping everything for the 6, because I suppose one goes hand in hand with the other. But keep as much proof as you can is key. The more you have, the better in the event that it needs to be looked at in the future.
Okay, thanks very much for that, Jeanette. Thanks very much to all the panelists. As I say, thank you very much for everybody that joined the webinar this morning. We will send out all the slides, and we will get back with those questions, answers to those questions that we weren't able to answer in the last 10 minutes. So thanks very much, everybody, and thanks for attending.